Scott, can you hear me?
I can. Can you hear me, James?
Loud and clear. It's like you're right here in the room with us. It's incredible.
Excellent. Well, apologies. I can't be there live, but thanks for having me.
That's okay. We'll keep a seat warm for you for next year, and welcome to come to Australia anytime. But first of all, from us, a big thanks for taking the time to be with us. I know it's late in the evening in New York. But for people who in the room that might not be familiar with Apollo, I was hoping maybe you could just give them a quick introduction about the firm and what's unique about the way that you invest.
Sure. Well, look, as Tom said, we're about a $700 billion alternative asset manager across lots of categories you're probably all familiar with. Credit in really all forms of credit, real assets, infrastructure, private equity. So really across the spectrum of alternative asset classes. But what I think makes Apollo unique, what makes us very different from many of the other peers you may know, is just the way we approach investing. There's a few core tenets, a few core beliefs, philosophies in our approach that really you can look at any Apollo product, any Apollo fund, and know right away it's an Apollo product. First of all, we are a value-oriented investor. So purchase price matters. We have this deep-seated belief, right? It's almost quaint, in this day and age, but that purchase price matters really across anything, whether you're talking about a building or a piece of credit or a company. Purchase price matters. And I think our industry and just the asset management industry in general lost its way for, the better part of 15 years as interest rates went to zero and stayed there. It was very easy to forget that purchase price mattered because, when the cost of capital goes to zero and stays there, well, the purchase price actually doesn't matter as much anymore because the capital markets, bail you out. And if the capital markets don't bail you out, if you hit a road bump, the government has bailed you out. And so it was very easy to lose your way a little bit. And as a result, that was good until it wasn't. Eventually, money's not free forever, and rates had to start rising with inflation, and all of a sudden people had to remember that a purchase price did matter. Now, thankfully, we stayed very true to that philosophy for a long time. Trust me, it was lonely in 2018 and 2019. We were the Cassandras telling people, watch your valuations, things are getting out of control. But so purchase price matters is an incredibly important, thing that really runs across all of Apollo. The second real tenet is excess return per unit of risk. We think about the world in terms of risk and return, which again sounds quite quaint, but in a world of 0% rates, right, nothing bad happened. So you didn't really have to worry about the risk part. You just chased the return. And so that you saw investors creeping up the risk curve in order to chase that return. And that was just something we refused to do. Our philosophy is we should be delivering excess return per unit of risk that you as investors are willing to take. And as a result, we don't, we may be huge. We may have $700 billion under management, but we don't invest in any asset class if we don't think it's a great place to be deploying capital. So those are a few things that I'd say really distinguish Apollo.
Well, we might just zoom out just a fraction before we get into some specifics around, where you are investing. But, in terms of the broader investing backdrop facing investors in the year ahead versus where we've come from, your colleague Mark Rowan has spoken a lot about, things not being as they have been in the past. Keen to know, what do you think are the most important things for investors to consider? What's the backdrop they're facing as we look forward?
Yeah. Look, we're in a really interesting time right now, right? A typical cycle, a typical economic cycle, meaning peak to peak or trough to peak to trough, typically lasts 6 or 8 years, right? We've come through a period where we had a 14-year upcycle. We've had what I call since 2022, probably the plateau, right? We haven't even hit our down cycle yet. So we're looking at a total cycle here that might be, 16 or 18 years. It's really unprecedented in modern times for this type of cycle to be happening. And you have markets that got so accustomed to just moving up and to the right that these markets just want to believe, right? And so you have, let me explain what I mean by that, right? The latest, Fed dot plot or Fed estimation, right, is 9 rate cuts over the next 2 years, 9 to 10 rate cuts, right? I don't know. My belief is that in order to get 9 or 10 rate cuts, we need to be in a recession, right? The Fed's going to have to be responding to that, to that type of outcome. But the market's not pricing in a recession. The market's pricing in 9 or 10 rate cuts, but no recession, right? The market wants to believe in the good stuff, but not really factor in, the bad stuff. I mean, look, nobody has a crystal ball. We look across our 50-odd portfolio companies, our 4,000 credit issuers, and while the market is growing more slowly than it was at the beginning of the year, we're not really seeing imminent signs of a recession. In fact, if anything, we're seeing inflation tamed but ready to rear its head again the minute the Fed steps off the gas. And we do think the Fed will start cutting rates because I think it feels like it needs to. But there's brewing wage inflation, there's brewing housing inflation, which I think is going to limit how much the Fed can actually be cutting. So I just think the answer is there's volatility ahead. The market doesn't know, we don't know, you don't know, but the market is sort of geared for, I'd say, pretty good outcomes. You can see how the markets are trading, both the debt and the equity markets. Credit spreads are as tight as they've ever been. Or certainly in a really, really long time, and pricing for perfection. And there's just a lot of room. There's a lot of room for things going the other way.
So, Scott, if I sort of read through what you've told me there, you're expecting rates not to fall quite as much as the market is pricing, and you're not seeing too many issues in the credit market. Is that a fair summation of where you see us in the rates in the credit cycle?
I'd say that's I'd say that's right. Fundamentals are probably as good or better than people anticipate, and technicals don't. Nothing points to why technicals rates are going to be falling massively, other than people's desire to see them come down.
Okay, so what about valuations? Like how big of a dispersion are you seeing between what you pay for in a private market versus what you see in public equity markets, and what are the expectations like in private markets for valuations?
Yeah, so that's another really good question, because while it feels like the S&P, for example, is pretty fully priced right now, the S&P is a bit of a misnomer, right? The S&P is really 2 indexes. It's the S&P 7 or S&P 10 and the other 490, right? If you look year to date, probably 70+% of the gain in the S&P has been driven by these 7 or 10 stocks, right? The other 490 stocks are up a little bit, but actually a third of those stocks, I just looked this morning, about a third of those stocks are down year to date, right? You wouldn't know that. People don't talk about that, but for the average public company, it's actually not been that much fun. The biggest companies that draw the most fund flows, they've been doing, the last couple of weeks notwithstanding, they've been doing, quite well. But Apollo has been quite busy. We've done a number of public to privates over the last year because there's interesting companies that are trading at reasonable valuations that actually are tired of being public. If you're a mid-sized public company, it's not a lot of fun, right? The big, massive, passive indexes aren't buying you. The days of the mutual fund stock picker looking for undervalued stocks, well, that business is going away, right? So the market almost doesn't care what you do. You just move with the general sentiment of the market, and it's very frustrating. And so you have a lot of companies that are looking to go private at reasonable valuation. So from an opportunity set, there's a lot of interesting things out there. Now, that may be different than, you take a tech or healthcare subsector, right, where you have companies that used to trade at incredibly lofty valuations. Maybe they've traded off. They're not interested in selling at these prices because they believe things are going to go back to normal, right? But you try to explain that normal 0% interest rates was not the norm, right? That was the aberration in 400 years of interest rates. But there's still a hope or a dream that you're going to head back that way. So there are some subsectors where the gap between buyers and sellers are a little bit wide. But for the most part, there's a lot of transactions to do, from a new deal environment.
You mentioned there taking some companies from public to private. Here in Australia, the biggest deal this year happened in private markets. The IPO market is very subdued and quiet. I know it's a similar state over in the US. Do you think that's a cyclical trend, or is that structural? What's your view?
I think that's a bit, there's some, we're in a depressed state, but I think based on what I was just saying earlier, right, the markets don't really care about a $3 billion company going public. Even a great, fantastic company, you can get public, but you're not going to get public at a great valuation. So, for a sponsor, for a private equity sponsor, if you bought the company at a really attractive price, you can go take it public right now, right? But who are the buyers? Well, the indexes aren't buying you. You're too small. The big long only guys, you're too small to matter. So you're kind of subject to hedge funds and other transitory buyers who are looking for a deal. So if you're prepared to go public at a mediocre valuation, you can probably get public. But most folks don't love going public at a mediocre. They want to go, they think they bought a great company. They want to go public at a great price. And so I don't see that changing anytime soon. I do think the IPO environment's going to be subdued for a while. You'll see stuff happening, but not like the go-go days of 4 or 5 years ago.
Scott, just before we move into a couple of the areas where you are getting invested, I stumbled or picked up on some numbers in Bloomberg that showed that the biggest firms, including Apollo, have increased the amount of cash or dry powder they have available from Q1 to Q2 this year. Just wondering, what does it take for you to put that money to work? Are we waiting for the Fed or an election, or is it just about the deal opportunity?
Yeah, no, look, it's the deal opportunity. And I think that statistic is true probably for the last 15 years, quarter to quarter to quarter. So I don't know that I would read more into that other than that's the direction of travel for the industry. We're putting money out at a pretty good clip. 24 will be a record year for, credit origination, for capital deployment, on the private equity. So no, there's a lot of activity. It's just fundraising's happening at a pretty strong pace as well.
Okay, so which trends or themes is Apollo attracted to over the medium to long term, and what are some examples of where you're investing in these opportunities?
Yeah, well, look, it's fundamentally, to be a value-oriented investor, you need to be somewhat opportunistic. You make hay when the sun's shining. But putting that aside and knowing that always to be true, there's some pretty big mega themes that are happening in the markets that we are really trying to jump on top of and get behind. We are at a time where companies are seeing like unprecedented need for capital, right? When you think about some of these themes, the digital transformation that's going on across just about every industry, and the amount of capital that's going in that has to be invested, whether it's data centers or working back to chips, power, the whole digitization of the economy, decarbonization, right? Everywhere around the world, massive amounts of capital. This is a 30-year spend that has to happen, trillions, tens, hundreds of trillions of dollars, over the next decades. Deglobalization is happening. Certainly, in the U.S., you're feeling it. After 40 years of moving industrial infrastructure to China has to be reversed in many, many industries, and a lot of that has to be rebuilt. So companies have to spend levels of capital in a relatively short to medium period of time that they don't have access to that capital. They don't have cash on hand. They don't even have the ability to access their regular debt markets to be able to do that. And so, they need access to all forms of capital, whether it's private investment grade that our credit business provides, or partnership capital through our hybrid value funds and other, related type, structured equity, structured credit type investments, or, outright partnerships, equity investments, buying assets, things like that. So it really runs the gamut across all of these asset classes that we operate in. And that's creating just an enormous opportunity to partner with companies and help them solve their needs. And so we're seeing that in spades, all day, every day.
Are you able to bring it to life with a couple of examples, a couple of recent examples?
Sure. So, one that got a lot of press, a few weeks ago, we announced a very large, or actually it's a little more than a few weeks ago now, a very large transaction with Intel. Intel is building a large, very state-of-the-art chip fab facility in Ireland. And we are partnering with them. We're providing $11 billion of capital, to partner with them in that facility to help them build that in a very structured relationship. This is a situation where, historically big investment grade companies, historically might not have taken structured capital from a firm like Apollo in the past. But, we've done that with Air France, with AB InBev, you go down the list, big investment grade companies. And these type of companies, they don't want to do it in $200, $300, $500 million. They want to do it in $2 billion, $5 billion, $10 billion, $20 billion type of transactions. And very few firms can really step up and have the structuring capabilities, the amount of capital required, and the home to place that capital, and that is what I think is really distinguishing, a firm like Apollo, what we do and how we do it.
Scott, you talked about those big mega themes, decarbonization, digital transformation. They're attracting a lot of interest and a lot of capital. How do you think about the returns that they can generate from you? Do you feel like when capital floods into these opportunities that the potential for return gets diminished?
Well, the answer is, of course, that happens, across the spectrum. The difference here is the order of magnitude is so great that for the foreseeable future, most of these areas, these themes, are going to need more capital than capital is available to chase it. And so, look, like any situation, some deals, when you actually analyze them, won't be that attractive. Others, will be. We try to pick our spots carefully and find those situations where we can bring our unique, capabilities, our unique, whether it's structuring, capital, cost of capital to bear, and try to do things that others aren't doing, so that we can earn that excess return for the level of risk we're taking, right? Because everything is not. Lots of folks, all they have is a hammer, so everything's a nail, right? Because we have everything from investment grade credit capabilities to sub-investment grade to mezzanine, structured equity, structured credit, all the ways to private equity. We can find the right, the right risk capital for that type of project to get the appropriate return.
I want to ask you a bit about something that I understand is a personal passion for you. You and your wife helped establish what's known as the Kleinman Center for Energy Policy in 2014. Just keen to understand why you have that strong personal connection with energy policy, and what some of the most impactful pieces of research that have emerged from that from that center.
Sure. Yeah. No. Actually, thank you for asking that. As Tom mentioned in his intro for me, I've been at Apollo for almost 30 years now, and I spent most of my career, the first 20 or so, really investing in a lot of cyclical industrial businesses, so big consumers of energy here in the States and globally. And this is somewhat of a U.S.-centric answer to your question, but it always struck me that, for a country that's so blessed with both natural resources and economic resources, from a policy standpoint, we did a horrible job promoting, both either, quite frankly, the economic outcomes or the environmental outcomes. And I just had always said to myself, at some point, if I had the ability to do something about it, I'd like to, find a way to really do something there. And so as it would happen, I had the opportunity to help establish an energy policy center at the University of Pennsylvania, where we could really, and this was back in 2014, before the energy transition was really big front page news. But it was very clear to me that that was the direction of travel, but that it was already starting to politicize, and we needed, some nonpartisan, actual primary research on important topics that we can get in the hands of policymakers to try to actually, influence sensible, data-driven outcomes. The second component of why we helped to set it up at a university as opposed to somewhere else is, I saw that this was really important to young people, but that young people were pushing in a direction but didn't necessarily have the vocabulary to talk about the energy transition or even understand the energy system in general. And so how do we educate, young people coming up through the system so that they have that vocabulary? They can actually, whether it's a casual vocabulary or it's something that they want to devote their careers to. And so can we build a curriculum around that to really educate all those, that span of students, and that's really what we've done over the last decade. We've been very fortunate. It's it's, as we all know, looking back over a decade, energy transition went from back of the newspaper topic to front of the newspaper topic. So got a lot more focus, a lot more attention, a lot more funding. To really build out. We've brought in a number of amazing professors. Maybe, you asked a question, I'll highlight one. We have a professor, her name's Jen Wilcox. She is, I'd say, the world's leading, expert on carbon capture and storage and the policy that goes around carbon mitigation, and carbon capture. And, she has been, actually, for the last couple of years, seconded to the, federal administration of the Department of Energy. And I'm sorry, my screen just froze. She's been seconded to the Department of Energy, but she's come back in the last year, and she's putting out a ton of great research on this. Carbon capture has been suppressed for so many years because it was viewed as cheating. The reality is we're so far up the creek, from where we need to be, that we need all of the above. And even the most, green environmentalists will now tell you, yeah, bring it on. And so her work is in enormous demand. And, she's fantastic, in the work that the center's putting out on that topic is fantastic, just to name one of many topic areas.
Okay. Well, Scott, we're coming close to time. I've got two questions I'd like to run past you, but we need to keep it pretty sharp. First one, just on that energy policy, has it informed investment opportunities for Apollo? Are you active in that space, and where?
Absolutely. Back to your question of, does too much capital, end up pushing, returns down? It's quite interesting. If you look, obviously energy transition investing has been really a popular topic over the last, 3, 4, 5 years. The issue that we saw was that most of that capital has been attracted to the growth and venture space, which, is hard. It's not something Apollo does. We don't really know that area. But picking a technology, a game-changing technology, and hoping it works, and having to invest enormous amounts of capital to make that happen is a tough sled. And so a lot of dollars ran in that direction, but a lot of that hasn't panned out the way people had hoped. Our focus has been much more on taking later stage technology and helping that, basically that brown to green, how do you scale up a winning technology that just needs capital and it's got a working facility and now it needs 5 facilities? Or how do you provide services to an industry that is clearly, working in the right way? How do you help companies go from brown to green. Companies have to spend so much capital. How do you help them do that? And so that's really been the focus area for us. We do that across asset classes like everything else: credit, real assets, infrastructure, equity, and it's been a real winning formula for us. So yeah.
Well, Scott, just a very quick one to finish off with, and it's an Australian-centric question. We talked about this a couple of weeks ago, but what do you see with retirement in Australia? We have this aging population, big pool of super. When you look down at Australia, what do you see as some of the challenges or opportunities that we have particularly with regards to retirement and super, which is an area Apollo's active?
Sure. Well, look, you guys can pat yourselves on the back, because in a world where, we have a massive retirement savings problem, Australia has probably done as good a job as any country in really mobilizing the population to be saving. The super system, was an amazing innovation by Australia, that has created really, proportionately a massive amount of retirement savings accumulation. And we spent a lot of time, of course, on the asset management side with the super system. But one of Apollo's specialties on the retirement side is decumulation, annuities, things like that. Once you've saved this money, how do you responsibly invest and spend that over, an unknown period of time? And that's the part that I think Australia is now catching up to. I think you're going to start seeing real innovations in the market, bringing really useful decumulation products to the population. That's what attracted us to the market. We've been active down there with partners, but you're going to see more and more of that, and that, I think, is going to be the name of the game over the next several years.
Well, Scott, that's where we're going to have to wrap things up for today. I just want to extend my thanks for taking the time to speak with us from New York and staying back late this evening. Could I ask everyone please to put their hands together for Scott Kleinman from Apollo Global?